This indicator has accurately predicted every major recession for the last 50 years, and the warning signs are flashing red again. Now, the question is, are you going to ignore them? Because today, we're diving into the most reliable crystal ball we have. Let's get to it.
Investors waking up this morning to a recession warning from the bond markets. The Dow plunging more than 800 points, sparked by a key economic indicator faltering.
A brutal day on Wall Street, stocks plunging as the yield curve inverted, sparking fears that a recession could be on its way.
The reason why we watch the yield curve so closely is that it has been an incredibly accurate predictor of recessions. Every time that yield curve has inverted, the economy eventually has gone into a recession.
So, if you ever wondered how professional investors, economists, or even the Federal Reserve itself anticipates downturns, it all starts here with the yield curve, specifically the spread between the 10-year and the 2-year Treasury. Now, here's how it works. Normally, long-term bonds like the 10-year pay a higher yield than short-term bonds like the 2-year, because if you're going to lend money for a decade, you want more return than if you lend for just 2 years. But when the economy looks shaky, something strange happens. Investors rush into long-term treasuries for safety, driving those yields down. And at the same time, if the Federal Reserve is raising interest rates to fight inflation, short-term yields rise. The result? Short-term bonds start paying more than long-term bonds. And that's called an inversion. And historically, when that inversion happens, recession follows. Nearly every single US recession since the 1970s was accurately predicted by a yield curve inversion. Now, the bond market has quietly outperformed the stock market, the housing market, and even the so-called expert forecasts at predicting recessions. And today, it's sounding the alarm again. But here's the thing.